I'd now like to ask our team that is going to present the findings from the 2025 CSBS annual survey of community banks to come to the front of the room. As we noted at the top of this conference, there are a lot of different elements that combine each year to provide insights and perspectives around this conference. Since 2014, CSBS has offered this annual survey through its own and through the significant efforts of our state banking commissioners and, of course, through the community banks that respond to the survey. The idea was to provide more current information in terms of what community banks are facing, but also to gather some real data that can be used in research, in white papers and others, and certainly over the many years of this survey, that is exactly what has taken place. So again, special thanks to CSBS, the commissioners, and to all of you who actively participated in the survey for your efforts. Quick housekeeping item: if you are wondering why maybe your Wi-Fi isn't working, thinking, I thought the St. Louis Fed would have better Wi-Fi, it appears that we may have left off an @ symbol in front of that password. So if you look at your Wi-Fi card, before the letter F, put an @ in there, and the world will open up to you. So apologies for that. And we're printing some new cards too. They'll be available outside, so I don't have to keep reminding everybody of that little addition. So also, those of you who have registered and those of you on the live stream, you should have just seen in your inbox that the 2025 survey was just sent to you. So there's a link on communitybanking.org. There's a link on CSBS's website, csbs.org. Everyone in the auditorium should have a hard copy. I see some of them out right now. So please follow along while our presenters, Joey Samowitz, Senior Policy Director at Policy Development at CSBS, Tom Seams, the Chief Economist at CSBS, and Kathleen Navin, Senior Business Economist in the Supervision Division here at the St. Louis Fed, present findings from this year's CSBS Annual Survey of Community Banks. So with that, Joey, I think I'm turning it over to you.
Thanks, Jim. Welcome, everyone. We are excited to share the 2025 results of the 12th CSBS Annual Survey of Community Banks. 12th. Time flies when you're having fun. These two experts, as Jim mentioned, are going to help me disseminate this year's results. I say this every year, but it continues to ring true. It's been an interesting year in banking. Last year, we presented on the heels of our first interest rate cut since March 2020, on the back of what many economists were calling a soft landing. Now we are again presenting after an interest rate cut that comes with a backdrop of a unique operating environment for banks and the broader economy, with tariffs, a government shutdown, and an abrupt pendulum shift towards a more relaxed regulatory policy environment. Based on this year's survey, we can see bankers continue to be impacted by rates and a competitive environment for deposits, while feeling better about that regulatory policy environment. This year's survey questions focus on current banking conditions, liquidity, regulatory risk, and technology. We also included special questions on deposit insurance and compliance costs. I encourage you all to pay attention to these results. Bankers are at the front lines of the economy, seeing trends take shape before it bears out in the data. At the end of the annual survey that you have in front of you, you'll see our 5 Questions for 5 Bankers series, which gives additional context to these results as we interview 5 community bank CEOs. Throughout today's presentation, I'm going to sprinkle in some quotes from those 5 Questions for 5 Bankers. And don't panic when you see the quote on the screen is a little shorter than what I'm reading off. That was for aesthetic reasons. I'm going to give a deeper quote when I read it off to the group. So it's great to be with you all as always. I see a lot of friendly faces in the crowd. This is a really impressive group of policymakers, regulators, bankers, academics. We're so glad that you're joining us today. We're going to ask that you hold your questions till the end to allow for the survey results to be presented in full. I'm going to get us started by sharing the key findings before I kick it over to Tom and Kathleen to go into the details. So some of the key takeaways this year: community bankers ranked net interest margins and core deposit growth as the most important external risks facing their banks. As I previewed, regulation fell to the 6th spot in the 2025 rankings of external risks. Bankers reported adhering to safety and soundness practices accounted for the largest share of their total compliance expenses, followed by money laundering and consumer protection standards. Cybersecurity once again took the top spot among internal risks, followed by technology implementation and costs. Signs of mergers and acquisitions activity picked up this year, with more respondents indicating seriously considering acquisition offers, although there's an interesting wrinkle that Kathleen will dive into later on that one. Credit and debit fraud was both the most common type of fraud reported and the largest source of dollar losses, followed by check fraud, then identity theft, and account takeover, respectively. And community bankers generally supported a change to the current deposit insurance framework, with targeted unlimited coverage and increased coverage the most popular solutions. But you'll see there was no strong consensus for how to actually handle updates to the deposit insurance framework, which in part explains why it's such a difficult policy topic to tackle. So I'm going to kick us off with our first quote from the 5 for 5. This is on net interest margins and core deposit growth, and from Lloyd Hamm, President and CEO of River Run Bancorp in Massachusetts. A tidal wave is coming toward community banks. Margin pressure, efficiency challenges, technology, talent costs, and compliance constitute that wave. We all need to move to higher ground. Some banks will try to stand still, some will merge early, and others will climb alone. Kathleen?
Thanks, Joey. Okay, so every year the CSBS annual survey essentially looks to bankers to get an idea of what are the risks that community banks are facing. We have a list of external risks that we'll present to you and also a list of internal risks a little bit later in the presentation. Starting with the external risks, what we saw this year in the survey results, as Joey mentioned, was net interest margins and also core deposit growth moving back to the top of the list. So when looking at these results, it's interesting to see how many bankers are saying these are either extremely or very important risks. And when we look at those two categories combined, which we have here in the two blue bars, 88% of community banks that were in the survey saw net interest margins as either an extremely or very important risk that their bank was facing. Second on the list, core deposit growth. 80% of banks in the survey said that this was either an extremely or very important risk, so moving up from last year. What was interesting is essentially we saw a three-way tie for third. So with 78% of banks ranking these as either extremely or very important, we had economic conditions, cost of technology, and cost of funds. So cost of funds dropped. It was actually tied for first last year. We saw that move down to 78% of bankers essentially in a three-way tie for third. That's interesting. We know Joey mentioned this survey followed the rate cuts that we had last year. We have seen some easing in short-term interest rates from the 2024 survey to the 2025 survey. So that probably explains some of that easing in the concern around cost of funds. What's really helpful is to look at these results from year to year. So as we build out the survey, as CSBS does the survey each year, we're able to look at how these results have shifted. So when we look at the top two categories on external risks, we see net interest margins over the last 4 years. It's been pretty consistent at about 88% of banks saying that this is an extremely or very important risk to their bank. But the rankings did shift. As we talked about a little bit in the key findings and we'll talk about later, we know regulation and cost of funds, they were the top two risks last year, pretty much tied for first. That pushed net interest margins down to third last year. But the share of banks essentially is the same. So we see that's pretty consistently in the top of this ranking. Core deposit growth, we saw a surge in concern around core deposit growth from the 2022 survey to the 2023 survey. We know that the market was shifting. Consumers became a lot more aware during that time. We know folks became a lot more rate sensitive, and we saw that result in the survey when you see that concern around core deposit growth. That's held pretty steady. This year, inching back a little bit to 80%, down a little bit from last year, but still a really important risk over the last few years. So another thing when thinking about the recent economic environment is the focus on inflation. And over the last few years, the CSBS annual survey has looked at what is the impact of inflation on your bank. Essentially, cost of deposits has been the most impacted when looking at these survey results over the last few years. Interestingly, this year, 48% saying extremely impacted. This was down from 59% last year, so you are seeing some ease in that, but cost of deposits still the number one most impacted thing from inflation for community bankers. Personnel expenses second. What was interesting is that operating expenses actually moved up in this year's survey. So what we're seeing is that when talking to community banks, there is more of a focus on the effects of inflation on those operating costs than we've seen over the last few years. So that was up from 11% last year, saying that this was an extremely impacted area of their business because of inflation, to 19% this year. Now, going back to the focus on core deposits, when asking community bankers what are the challenges around attracting and retaining core deposits, the number one answer was bank market competition. Essentially, 83% of bankers said this was extremely or very important, again, focusing on those two blue bars there in our chart. There was also a lot of conversation around economic uncertainty, with 49% of community bankers surveyed noting that this was either extremely important or very important when talking about attracting and retaining core deposits. Now, interestingly, this was not very different from last year's survey. So I know there has been a lot more focus on the economic uncertainty in the overall landscape, but this pretty much held steady over the last 2 years. Now, when looking at bank market competition, there is an entire section in the survey on bank market competition for a variety of products. So while we just were focusing on deposits, you can look at this for agriculture, for consumer loans, a wide variety of products and services. And we have the list here. Now, when looking at this and asking community bankers, who is your primary competitor? There were 7 of 9 categories where the primary competitor was another community bank. So I have the shares there. You see on both of the deposit categories, it's other community banks that they're competing with. But you see that there's pretty close and a lot of large competition also from those local, regional, and national banks for a variety of these categories. Now, the 2 categories where the primary competitor was not another community bank were payment services and wealth management and retirement services. One thing I wanted to note that was interesting in this year's survey was on payment services, while the primary competitor was local, regional, and national banks, we saw an increase, and it's kind of light up here, but you can see it in your packet as well. The non-local, non-bank, non-credit union, so the all other, which would include fintechs, that share, essentially banks said 28% of community banks in the survey said that was their primary competitor. And that was up materially from last year's survey. So we're seeing that increase in competition there on payment services. And I think that will be a very interesting category to watch in the years ahead. Essentially, that was up 9 percentage points from last year. Now, given the competition for core funding, I thought it would be interesting to look again at a question we've asked, or the CSBS has asked for several years, and that's around wholesale funding sources. CSBS did a deeper dive in this last year, so if you're interested, you can take a look back, but this question has been in there for several years. Essentially, public funds continue to be at the top of that list, and then FHL bank advances, also 70% of banks that were surveyed are using these and expect to continue to use these. With that, I'm going to hand it over to Tom to take a bit of a deeper dive into some of the factors around these results.
Thank you, Kathleen. All right, well, here we go again. Seems like I say this every year. It's all about interest rates when it comes to these external risks. And so we're showing the net interest margin here for the community banks and the dotted line in the industry overall. What you can see really is the roller coaster ride that banks have been on really since the pandemic years. And that has a lot to do with the shifts of interest rates going up in 2022 and 2023 and then back down a little bit in 24 and again this year. What's this button? Yeah. So this is a chart of the yield curve with the 10-year Treasury plotted with the federal funds rate. And the highlight here is, again, just to show over those last couple of years that banks have been in this inverted yield curve environment, which is really, the most difficult, really, type of environment for bankers to have to deal with. And they've actually done it quite well. Again, with the net interest margins still being pretty good ranges. And what we're showing here is the orange line is the yield on the earning assets, and then that bottom line there is the cost of funding. And so the margins have increased a little bit, mostly because, again, that cost of funds that Kathleen had alluded to earlier has fallen a little bit, while that yield on the earning assets continues to be okay. Other challenges, of course, that this presents for community bankers is to manage the unrealized losses that they have on their investment securities. And this started, of course, back in 2022 when the rates started to go up quite rapidly. But it's still pretty sizable, I'd say, for these unrealized losses. So I will turn it back to Kathleen, or to Joey.
Yes, to kick us off with our regulation and compliance section, I have a quote from Clayton Laguerre, the president and CEO of Merchants and Marine Bancorp in Mississippi. Quote, "The challenges we've faced recently have really stemmed from the continually shifting expectations and the reinterpretation of longstanding rules and regulations. It sometimes feels like certain circles on the federal side have a, quote, flavor of the month club. What are we going to reinterpret today? The rapid shifts in expectations, interpretations, and reinterpretations have been more onerous for us in the last few years than I can remember. It's been a very challenging and has consumed significant time and energy." Kathleen?
So you may have already noticed, and Joey alluded to this earlier, that regulation in this year's ranking of external risks, it dropped dramatically from a tie from first last year to sixth this year. And when we look at the share of community banks that noted this was either an extremely or very important risk, we saw a material decline from 89% in 2024 survey, when again that was tied for first, to 75% this year. So while still a concern that's in kind of the middle of the pack of this list, we see a material improvement there when surveying community banks. Now, I wanted to talk a little bit about some of the new detail in this year's survey. While the CSBS has long asked questions about compliance costs and essentially the share of a variety of expense categories and what can be attributed to compliance, this year there were some additional questions to really get to the bottom of that. The first being essentially looking at the share of total compliance costs allocated to different expense categories. And what you see here is then what you look at for community banks on average, when looking at total compliance costs, the majority is due to personnel costs. Essentially 58% going to personnel, 17% to data processing, and 11% to accounting and auditing. So it's really helpful to look at that, and it actually is a really interesting insight, because when you look at personnel expenses, only 13% of personnel expenses on average are due to compliance. But when you look at compliance expenses, the majority are due to personnel. So it really gives you an interesting look at the data that we hadn't had before. And Tom's going to take a more of a deep dive on that first question in a little bit. Another question that was new to the CSBS annual survey this year was really getting to the bottom of what different laws, regulations, areas of business are, behind these compliance costs. The results here essentially show that 27% of those compliance costs were due to adhering safety and soundness practices, 25% related to anti-money laundering, and 23% to consumer protection. So again, some new questions this year to get to the bottom of those compliance costs. And to really dive deeper into this area, I'm going to hand it over to Tom.
All right, thank you. So CSBS also does a quarterly community bank sentiment index, where we ask community bankers around the country their sentiment on 7 different indicators. And what's shown here is one of those indicators, which is, do you think regulatory burden for the upcoming year will be lighter, the same, heavier, or I don't know? And so the lighter there is in blue, the blue bars, and the heavier is in the yellow bars. And then the index that's created from that is on the right-hand axis, and 100 is that neutral level. So as you can see, ever since we started the survey, this indicator has really been in the tank in terms of how community bankers think about regulatory burden. It popped up last year, right at the time of the election, to exactly even. They're at 100. It had hit 130 earlier this year, and now it's down to 114, 115 kind of a range. So this has been an issue for a while, and it's turned up in our annual surveys as well. And so I took a deeper dive into the annual survey to ask this research question: what effect do banking regulations have on banks of different asset sizes? And there's kind of a gap in the literature in terms of actually being able to empirically test this. It makes kind of intuitive sense that if you have a new regulation come on board and you've got to deal with it, that a smaller institution, one additional person to hire to deal with that is going to cost a lot more than for a larger institution that might even be able to absorb it amongst the staff that they already have. So it makes this kind of intuitive sense. And in the survey, we asked the question, over the last, I looked at the last 10 years of the survey here. What is the average compliance cost as a percent of each one of those expense categories? Okay, and so we got these 5 categories, and now you have to remember these are self-reported results. Okay, so they're making an estimate in many cases. In fact, sometimes you get a lot of 10% results that might go across. But others get really deep dive and you get an 8.65 or something like that. But these are self-reported results. But I know the banks that took the survey, and no one else knows that. And so I was able to dive in and match up their survey results with the bank and look at all the performance indicators, and the size of the institution was the main thing that I wanted to look at. And to Kathleen's point about the personnel cost, it's a large dollar chunk. It might be a small percentage chunk. It is always between kind of this 10 and 12% per year overall. But there's a difference between the smaller institutions and the larger institutions, as you will see. So the first thing I did was chop up the data into quartiles. Okay, and so the red line is the smallest. This is the 25% line. The smallest quartile of banks would be those below that line. The dark blue line is the largest quartile of banks. And so if you look at the 2024 data, what we're saying is a small bank in this research study would be anything under about $200 million. And a large bank would be anything over $900 billion in the survey. Okay, and these are just surveys of community banks, and so everything's under $10 billion as that overall threshold. So what do we find? Well, here are the community bank personnel expenses that are attributed to compliance by quartile. Smallest banks, again, are in red. Largest banks are in blue. You can see that there is a difference between there, and there is in fact a statistically significant difference in there. In this conference, you're going to see a lot of asterisks. And you see these asterisks down here. I gave you the formula so how you can determine if something is significant at the 1% level, the 5% level, or the 10% level. All of these, every single year, was significant, statistically significant at the 1% level. Here were the actual numbers for the smallest quartile and the largest quartile, and then the difference between those. And you can see that difference across the board is 4 to 6% almost every single year. And so these were big differences in the a disproportionate burden really for those smaller institutions. Well, did that hold also for our other categories? Looked at data processing, and once again, statistically significant differences between the smallest institutions and the largest institutions for every time period across the survey since we started doing this survey. I think we might not have had that question the first year, so I had like 10 years of data here, and I haven't analyzed this year's yet. How about legal costs? Actually, no significant difference except for 1 year there. I can't tell you what happened in 2017 on the legal front, but the that doesn't really matter. There really wasn't much of a difference between legal costs for the various sized institutions. But there was, again, for audit and accounting and audit expenses, these were statistically significant differences across every single year. And then again, for consulting expenses, we see that the smallest institutions are paying, a greater share of the consulting expenses are going towards compliance. You can see that that's coming down, which probably means that they're learning how to deal with these compliance costs internally and not having to go out for help elsewhere. So the results show that there's some data-driven evidence here that the smallest community banks are disproportionately burdened by compliance costs in those 4 areas. I also looked, what are the other characteristics of these smaller banks? They tend to have higher capital, they hold more liquidity, they tend to be more ag related, in these smaller communities. They don't have as much CRE, C&D, or C&I loans. They have lower asset quality, which is kind of interesting. And they generally have wider net interest margins and lower profitability, but that's not always the case. It wasn't the case in every single year in the survey. So if you're interested in this paper, I believe it's out on the website for the conference program. And it's also on the CSBS website. Go to csbs.org/research. You can find the paper out there. I'm trying to see where I can place it from here. I'd also like to add that CSBS has a group of research scholars. We have 6 scholars. 3 of them are in the room here. We have Allison Nicoletti over here from Penn. We have Jill Satina up there from Texas A&M, and we have Matthew Whitledge over there as well from Mississippi State. These are 3 of our 6 scholars. 2 of these scholars are working diligently on putting together a longitudinal database of the entire annual survey results and so forth, so that researchers and others can dive in on these data points in the future. So that's all I have on that. Back to Joey.
Thanks, Tom. So to kick off our next section on cybersecurity, I have a quote from Lindsay Spitzer, the president and CEO of Bluffview Bank in Wisconsin. Quote, unfortunately, people are probably the weakest link. You can have the best designed systems and controls, but you can't stop somebody from opening an attachment or clicking a link. We spend a lot of our time educating our staff on phishing attempts, and we do a significant amount of testing. We have hundreds of emails sent per month to test our staff of 27. So, Kathleen?
So looking at the set of internal risks that are included in the survey, this is not a surprise. It's pretty much true every year, with cybersecurity taking the top spot of internal risks that are facing community banks. Essentially, if we look at the shares, this year 94% of surveyed community banks noted this was an either extremely or very important risk. Down a little bit from last year, but you see it kind of fluctuates in that range over the last couple of years, consistently the number 1 spot. So with that, I will turn it over to Tom.
Yeah, there's some sobering statistics here, really, when it comes to cybersecurity. 75% of surveyed businesses say fraud has negatively impacted revenue. 13% reporting losses, 10 to 20% of their revenue to fraud. Voice cloning is one of the newer ways to attack and steal. And 77% of victims there report financial loss. And fraud losses in the U.S. from generative AI are expected to climb from about 12 billion a couple of years ago to 40 billion a couple of years from now. Joey?
All right, so our next section is technology implementation and costs. This quote is from Mark Packard, president of Central Bank in Utah. Quote, over the last 5 years, our compliance labor costs have increased 58%. Our software costs increased 74% during the same period, so our overall compliance costs have increased by about 62%. I'm sure there will be continued software improvements, especially with AI, but compliance costs will continue to increase over time. Hopefully, with the help of AI and other technology, we'll be able to slow down those increased costs of ongoing and increasing regulation. Kathleen?
So if you noticed when we were showing the internal risks earlier, the second spot going to technology implementation and costs. What's interesting here is that that share has been steadily rising over the last few years. So we know with the rapid adoption of technology and I loved what Commissioner Salazar said earlier about the challenges but also the opportunities around technology. We know this is really a focus for community bankers, but you do see that increase in the risks that they see associated with technology implementation and cost over the last few years. Also interestingly, that when it comes to what is preventing community bankers from adopting new technology, you see that cost and ability to implement is at the top of that list, followed by cybersecurity risks and limitations of core service providers. With that, I will turn it back to Joey.
All right. On mergers and acquisitions, we have a quote from Norm Manai, the president and CEO of CBTC Bank in California. Quote, on the M&A side, it's primarily about valuations. Indices for small and large banks are still down and not aligned with fundamentals. Even Citi, which is famously trading below book value, isn't at a level that would spur M&A activity. As a result, deals are few and far between, especially in rural markets. Kathleen?
So as Tom mentioned earlier, there's a lot you can do with the data from the CSBS annual survey. And for questions that have been asked for a longer period of time, you have a longer time series that you can evaluate. This was really interesting in this year's results on mergers and acquisitions activity. So what we saw was that on the question of have you received and seriously considered accepting an acquisition or merger offer in the last 12 months, a jump from 6% of survey participants to 12% this year. So essentially a doubling in that share. And when you look at how that compares to pre-pandemic, it's actually back in line with pre-pandemic levels. So after the pandemic, that had really fallen. We know it's been very low for the last few years, different interest rate environment, et cetera. But we did see an increase this year when evaluating the results from the survey. Now, what's also interesting is that there's a partner question to this on asking, have you made an offer to acquire or merge with a target institution in the last 12 months? And what you see here is that while that share has been higher, we didn't see the same jump. So when it comes to actually offering, we're not seeing that in the survey sample that we have. So 14% of community banks that were in the survey, consistent with that kind of pre-pandemic releveling. So an interesting result there. And we're going to kind of go through some of the special questions quickly. I know we want to be cognizant of time. So with that, I'll turn it back to Joey.
Yeah, thanks, Kathleen. So on fraud, and Tom sort of got to this a little earlier, I've got another quote from Lloyd Hamm that provides some more context for what banks are actually experiencing in real time. Quote, recently, along with hundreds of other banks, we were targeted by AI-assisted fraudsters who obtained customer data from outside sources and purchased lists. They knew exactly who our customers were. Another bank in our market experienced the same attacks. Fraudsters called business customers, impersonated the bank, and attempted corporate account takeovers by asking for login information. One customer provided that information, realized it quickly, called us within the hour, yet $16,000 had already been transferred. That may not seem large, but for that business customer, it was significant. Kathleen?
Thanks, Joey. So on one of the new special questions in this year's survey was looking at the number of fraud cases and how are they attributed to what type of fraud. What you see here on the results is that 59% of fraud cases were due to credit or debit card fraud, and then followed by check fraud and identity theft and account takeover. The second question was on dollar losses from fraud according to the various types. What you see here is things are a lot more even between card fraud and check fraud. 38% of dollar losses attributed to card fraud, and then 30% attributed to check fraud. And I found this to be a very interesting result because while only 17% of cases are due to check fraud, 30% of losses are due to check fraud. So each individual case kind of has a bigger hit when it comes to the loss from fraud. I think that's why when going out into the district and talking to community bankers, we see that focus on check fraud. Also, though, when you have those conversations, you definitely are hearing more about identity theft and that, kind of the challenges to some of the newer technologies, the AI environment showed up here in this first year of survey results on this question. And for the last section, I'm going to move it back over to Joey.
Yeah, so on deposit insurance, we're doing something a little different. This isn't a quote from our 5 for 5, but actually from an audience member. This is Arkansas Commissioner Susanna Marshall and House Financial Services testimony back in February. Quote, small businesses in rural Arkansas should not feel compelled to leave their community banking partners simply because they worry the federal government will not protect their funds unless they are placed with a too big to fail institution. While the costs, benefits, and trade-offs of different deposit insurance reform options are certainly complex, Congress should have meaningful policy discussions about whether raising the deposit insurance coverage limits for business operational accounts would promote a more level playing field for community banks and their small business customers. Kathleen?
So for this special question, community bankers were asked, if you were to update deposit insurance rules, which of the following solutions would you prioritize? And what you see here is that 80% of community bankers did feel that they would offer an alternative solution, so only 20% saying no change, about 20%. And the top two solutions were targeted unlimited coverage and then increased coverage. Under targeted unlimited coverage, this essentially would mean that certain account types would have unlimited coverage, while others, such as non-interest bearing transactions accounts, would have limited coverage. And then under increased coverage, what was interesting was that respondents could write in the limit amount that they would suggest, and this was just a write-in question, and a majority, so 72%, wrote in $500,000 for the increased limit. So an interesting result from the new special question this year. And with that, I don't know if we have any questions where you just have to ask right away. I know we are at 10 o'clock, so we want to keep us on schedule. But if there's any, I'll just maybe give a moment if anyone has a question that must be answered.
We successfully exhausted all of our time to avoid answering any questions.
You can come find us.
Yeah, and we have
sessions.
a break coming up after our next session, and the three of us will be here both days. So I know for me, I love talking about this survey. It's definitely the highlight of this conference, as well as many other things. So, but with that, we'll turn it back to Jim.